Welcome to the debate. Imagine just for a second that your commercial warehouse sustains severe roof damage in a localized storm. Before you even have the time to, physically inspect the facility or pick up the phone to call your broker, a satellite has already assessed the structural integrity of the building.
Wow. Yeah.
Right? And an AI model has cross-referenced that imagery with the specific weather event, estimated the repair costs against current local supply chain pricing, and initiated a wire transfer directly to your operating account. We are no longer talking about evaluating risk through intuition and, Excel spreadsheets. We are talking about an entirely automated financial mechanism.
Well, it is an incredible shift, definitely. But it comes with a massive catch. If that same satellite imagery detects a, say, slightly degraded roofing membrane before the storm even hits, and the algorithm instantly decides to drop your coverage based on that single data point, who do you call? I mean, the machine isn't going to negotiate with you.
And that exact tension is what brings us to our subject today, which is drawn directly from the recent material in the Magoon Group Podcast. We are examining the rapid, truly immediate integration of artificial intelligence into the commercial insurance industry.
Yes.
So the central academic question we are unpacking from this material is a structural one. Is this massive algorithmic data processing capability fundamentally replacing traditional human mechanisms in the industry? Or conversely, is it elevating the complexity of risk to such a degree that expert human advisors are more critical than ever?
Exactly. Because you can look at the exact same data, the exact same technological leaps, and come to two entirely different conclusions about the future of the industry.
I look at this data and I just cannot see how the human underwriter or the traditional broker survives this transition. I will argue that AI's unprecedented ability to instantly analyze thousands of variables and automate these processes represents a fundamental shift. Algorithms aren't just assisting anymore. They are systematically replacing human operational dominance. The algorithm is, essentially, becoming the whole ballgame.
See, I look at the exact same data and come to the complete opposite conclusion. I will argue that because AI exponentially increases the complexity of risk in data, it permanently solidifies the necessity of human strategic advisors. The more complex and unforgiving the algorithm becomes, the more a business requires a human expert to build trust and translate that complexity into an actual business strategy.
Let's pull the lens back a bit and look at the fundamental architecture of the insurance mechanism. If you really think about it, insurance is uniquely vulnerable to total algorithmic takeover.
Really? Total takeover?
Yes, total. Why? Because we aren't manufacturing physical goods. Insurance is, and honestly always has been, a purely probability-based, data-driven business. It is the business of evaluating information. For decades, insurers have stockpiled highly structured historical data. Every policy written, every property inspection, every lawsuit, every minor fender bender, it's all just a data point.
It is the ultimate big data industry, absolutely. I'm with you there.
Right. And artificial intelligence's core competency is pattern recognition across those massive data sets. It does this far better and infinitely faster than human cognition ever could allow. But what we are seeing now is a fundamental shift in how that data is used. Historically, underwriters had to rely on proxy data to guess your risk. They would look at, the zip code of your warehouse or the credit score of your CEO to predict if you were going to file a claim. Today, AI allows them to use direct behavioral data in real time, ground truth. That shifts the entire underwriting mechanism. Decisions that historically took an underwriter days of manual review now happen in seconds because the machine isn't predicting anymore. It's just reading the active reality of the business.
I hear the sheer scale of the data you're describing. And yes, the shift from proxy data to direct data is real. But this interpretation mistakes extreme automation for actual strategy.
How so?
Well, there is a vast, unbridgeable difference between processing ground truth information and making a strategic business decision. Yes, AI provides significantly better, faster information. Nobody is denying that. But it does not replace the human decision maker because raw data lacks context.
How does a satellite image of a collapsed roof lack context? It's a collapsed roof.
Because underwriting a business isn't just about the physical integrity of one roof. As underwriting becomes hyper-sophisticated because of these AI tools, businesses are facing increasingly unforgiving applications. The algorithms, they demand operational perfection. If your data is perfect and it shows you are an elevated risk, the algorithm simply spits out a rejection. It redlines your business entirely.
Which is mathematically accurate based on the risk.
Sure, but this explosion of complexity means organizations absolutely require human advisors who deeply understand carrier appetites, risk strategy, and coverage design. The machine can calculate the exact probability of that roof collapsing, yes, but it cannot negotiate the nuanced terms of a policy that protects a company's unique cash flow requirements while they upgrade their facilities. Technology handles the data, but humans build trust.
I'm not convinced by that line of reasoning because the negotiation you are describing is becoming mathematically irrelevant. Let's test this by looking closely at the mechanics of underwriting today, as highlighted in the source material from the Magoon Group Podcast. We are moving entirely away from basic spreadsheets to neural networks that evaluate hundreds of thousands of variables instantly.
Right.
Let's take commercial property as an example. The model doesn't just look at the roof anymore. It synthesizes local crime statistics down to the exact street corner, evaluates long-term geographic hazards, analyzes social sentiment data regarding the business on the internet, and cross-references real-time financial performance.
Which is exactly why the business owner is completely overwhelmed.
Overwhelmed maybe, but the point is the human underwriter on the carrier side isn't steering the ship anymore. Think about the old analogy of maritime navigation. Old underwriting was like navigating by the stars. You had a general idea of where you were going, you did your best, and you hoped you didn't hit a reef.
Yeah, it was very manual.
Right. But AI isn't just a better telescope. It's a modern GPS system. It doesn't just assist the journey, it entirely takes over the navigation. Let's use a different angle. Old underwriting was like a bouncer at a club checking your ID once at the door. They manually review you, decide you are safe, and let you in for the year. AI and continuous monitoring is like having a chaperone follow you around the club all night, constantly analyzing your real-time behavior.
Okay, that's a vivid picture.
If the AI chaperone processes 10,000 variables and dictates that your risk profile has spiked because of your behavior in the club, the human underwriter isn't going to overrule the math. The machine's recommendation effectively becomes the mandate. The human is entirely marginalized.
I come at it from a different way. Your chaperone analogy is exactly why the human advisor is more critical than ever. If you have a digital chaperone following you around all night, ready to kick you out the moment you take a wrong step, you desperately need an advocate who negotiated the rule of engagement with that chaperone before you ever walked in the door.
But the rules are just math. They aren't algorithmic probabilities. You can't negotiate with an equation.
But the impact of those rules is operational reality for a real-world business. Look, you are describing incredible efficiency on the carrier side, but efficiency is not autonomy. The AI is identifying subtle correlations, say, a link between your specific manufacturing supply chain and a localized weather pattern, but it generates recommendations based on historical training data.
Strong recommendations.
Sure, but by taking the friction out of the system, by lowering the administrative costs and speeding up the claims process, AI empowers the human underwriter to focus entirely on complex risk acceptance. It removes the tedious data gathering phase. The AI tells you the standard route is blocked. It is still the human driver who decides if an unconventional alternative route aligns with the overall goal of the journey.
But that speed in claims and underwriting creates a massive byproduct for the business owner, which is a demand for absolute operational perfection. And this extends far beyond just underwriting into the realm of fraud detection and active risk prevention. The algorithm has essentially turned insurance from a static annual contract into a dynamic daily software subscription.
A dynamic software subscription. That is a fascinating way to frame it, actually.
It is, because the predictive power fundamentally alters the economic mechanism. The Magoon Group material notes that AI detects subtle fraud patterns that human investigators practically never catch: geographic clusters of specific claims, deep identity inconsistencies, repeated use of specific repair shops with highly suspicious timing. But let's take it a step further into risk prevention through IoT, the Internet of Things. We are seeing constant telemetry data flowing directly into the AI.
Right, telematics, dash cameras in fleets, water leak sensors in commercial buildings, that sort of thing.
Let's look at the mechanism of a trucking fleet. Historically, an underwriter reviewed the driving records of the fleet once a year, right? Now the AI is monitoring the G-force of every braking event, lane departure warnings, route deviations, and even tire pressure in real time.
It's a lot of data.
It's constant. The algorithm isn't just analyzing the risk of that fleet, it is actively managing it. It is adjusting premiums or coverage limits based on the daily behavior of the drivers. The algorithm is now the active risk manager, bypassing the need for a human to oversee these operational realities. If the machine is doing the monitoring, the adjusting, and the claims processing, what exactly is the human doing?
That's a compelling argument, but have you considered how this exact explosion of continuous monitoring radically shifts the burden onto the business itself? Let's stay with your trucking fleet example. The carrier's AI is now demanding impeccable data. A business owner cannot simply slap dash cameras in their trucks, install telematics, and assume they are perfectly covered.
Well, they have to use them.
Exactly. If the AI is instantly denying a claim or spiking a premium based on a hard braking sensor reading, that shifts the burden onto how the business manages its sensors and its people.
Which the AI tracks.
It tracks it, but it cannot fix it. The business has to integrate that data into a culture of safety. They need flawless operational execution. If an AI flags that a fleet's night shift drivers have a 14% higher rate of lane drift, the AI just raises the premium. It penalizes the business.
To correct the behavior.
Right, but to actually solve the problem, the business owner absolutely needs a strategic consultant to help them align their operations with these new algorithmic expectations. You need a human expert to look at that data, sit down with the fleet manager, and translate that into a narrative of operational excellence, like, say, changing shift schedules or instituting new training that the carrier will then reward with better rates. Bridging the gap between raw, punishing sensor data and actual organizational change is a distinctly human endeavor.
That's an interesting point, though I would frame it differently. If we accept that the technology is now handling the massive data loads, spotting the subtle fraud patterns, monitoring the manufacturing equipment 24/7, and predicting the repair costs down to the cent, then the traditional role of the insurance advisor is dead.
I mean it. The person whose job was essentially to take a client's paperwork, shop it around to 5 carriers, and match them with the best policy, that role is effectively obsolete. The AI does the matching better, faster, and with infinitely more precision, without any human bias.
I actually completely agree with you on that specific point. The traditional policy seller is entirely obsolete.
Okay, good.
Yeah, if an advisor's only value proposition is acting as a transactional middleman for paperwork, the algorithm has already replaced them. But you are completing the death of the middleman with the death of human strategy. The role doesn't disappear, it evolves into a strategic risk consultant.
Evolve how? By just explaining what the computer said?
No, by actively designing the conceptual framework of the business's risk. This is exactly where the Magoon Group's insurance intelligence approach, which was so heavily highlighted in the material, becomes the prime example of the industry's future. This isn't about selling a policy.
It rarely is anymore.
Right. The insurance intelligence approach deliberately combines deep industry expertise, strategic thinking, and highly personalized advice with the technology, data, and AI. The goal isn't just placing insurance. It is helping clients protect the tangible assets they've built while simultaneously positioning them for future growth.
But how is that practically different than what the algorithm does when it dynamically adjusts coverage to match growth?
Because you cannot automate strategic foresight. You cannot write an algorithm that sits down with a CEO, understands the emotional and financial nuances of their 5-year aggressive expansion plan into a new unregulated market, and structures a customized risk transfer mechanism that aligns with their unique, highly personal risk tolerance.
I mean, we are getting closer to that.
But AI gives us perfect hindsight. It gives us incredible real-time processing. But an algorithm can only train on historical data. By definition, AI cannot predict the nuances of a completely unprecedented systemic risk in a novel business model. It requires a human conceptualizing the framework first. Technology handles the data,
but it takes people to build the trust necessary to make massive strategic leaps.
I see why you think that, but let me give you a different perspective on this insurance intelligence model. Is it not highly probable that this approach, noble and effective as it is right now, is simply a transitional phase?
Transitional? In what way?
Think about the trajectory of the technology. We are currently in the early days of this integration. Right now, yes, you absolutely need a highly skilled human consultant to hold a CEO's hand as the industry shifts from static contracts to dynamic subscriptions. You need someone to translate the AI's findings.
Yes.
But as these systems become increasingly autonomous, as the IoT sensors automatically adjust coverage parameters in real time across the entire global supply chain without any human intervention, that strategic advisory role will inevitably shrink.
I don't see it shrinking, I see it elevating.
But the complexity of the data will become so vast, and the AI's ability to instantly model out 5-year expansion plans using global economic data will become so precise that human strategic translation won't just be unnecessary, it will be an operational bottleneck.
A bottleneck?
Yes. The algorithm won't just recommend the policy. It will dynamically adjust the coverage limits minute by minute based on real-time financial metrics, supply chain disruptions, and IoT telemetry. It will instantly hedge the company's risk on the global market. The endpoint of this trajectory isn't human-AI collaboration. The endpoint is the total, uncompromised automation of the mechanics of insurance.
I'm sorry, but I just don't buy that. Let me tell you why. Business, at its very core, is fundamentally a human enterprise. It is driven by human emotions, human ambitions, and, frankly, human blind spots. You talk about modeling a 5-year expansion plan, but AI cannot model the sheer irrationality of human markets or the unpredictable nature of human leadership.
But it can model the mathematical probability of failure.
Probability is not destiny. And when a business is facing an unprecedented crisis, something entirely outside the training data, they do not want to consult a dashboard.
Even if the dashboard is right?
Even if it's right. The technology eliminates the administrative friction. Absolutely. Processing claims in 3 minutes is a miracle of modern efficiency. Catching complex fraud clusters saves the industry billions. But that exact technological leap allows the advisor to stop acting like a human calculator and start acting like a true partner.
Fair enough.
They can spend less time on spreadsheets and more time deeply understanding the nuances of the client's actual operations. As the source material continually stresses, the winners in this new paradigm won't necessarily be the companies with the most raw technology. Algorithms will become commoditized. Everyone will have the same AI eventually. The winners will be the organizations that successfully combine that commoditized technology with irreplaceable human judgment and deeply trusted relationships.
So, bringing our conceptual frameworks together based on the Magoon Group's insights, my stance remains resolute. The unprecedented ability of artificial intelligence to process decades of structured data, to instantly evaluate highly complex underwriting variables like localized satellite imagery and behavioral telemetry, represents a fundamental algorithmic takeover.
Right.
The core economic mechanics of insurance, evaluating a risk, pricing it dynamically, and paying claims are being actively usurped by algorithms that perform these tasks with a speed, scale, and precision that makes human intervention not just slow but actively detrimental to the mathematical model. The shift toward proactive algorithmic risk management signifies that the machine is replacing human operational dominance.
And my position remains that while AI undeniably and drastically improves information quality, processing those claims at lightning speed, and catching subtle multi-layered patterns of fraud, this exact technological leap necessitates human judgment more than ever. By eliminating the administrative friction, the AI exposes the raw, hyper-complex reality of a business's risk profile. And because that landscape is now so unforgiving, businesses absolutely require trusted relationships and strategic risk consulting. Approaches like the Magoon Group's insurance intelligence are not transitional. They are the permanent future. Human experts are required to interpret algorithmic data, navigate complex carrier appetites, and architect the operational alignment necessary to secure the best possible outcomes for human-run businesses.
What we undeniably agree on, and what the material makes abundantly clear, is that artificial intelligence is fundamentally rewiring the commercial insurance industry today. This is not a theoretical exercise for a distant science fiction future. We see it happening right now in the property claims being approved and wired in minutes, in the billions of dollars being quietly saved through automated fraud detection, and, most importantly, in the massive structural shift from merely paying for losses after the fact to actively preventing them through continuous, real-time IoT monitoring.
Exactly. The timeline is not tomorrow. The timeline is this afternoon. Where we continue to respectfully diverge is on the ultimate hierarchy between human and machine in this new paradigm. You see the human element inevitably becoming secondary, sort of a vanishing administrative layer soon to be entirely automated out of existence. I see the technology acting as a powerful catalyst that finally elevates human judgment out of the paperwork and into a higher, strictly strategic necessity.
It is a profound and fascinating tension. Examining industry disruption through these multiple lenses allows us to see this technology simultaneously as a relentless automation engine stripping away inefficiencies and as a demanding tool that forces deeper, more meaningful human advisory relationships just to survive its complexity. We highly suggest our listeners explore the original Magoon Group podcast material further. Understanding the actual mechanism of these dynamics is absolutely crucial for evaluating how your own organizational risk, your telemetry, and your operational data might be judged by these systems in the very near future.
It really does completely reframe the questions you have to ask about your own business operations. If your data is speaking for you, you need to know exactly what it's saying.
It absolutely does. Ultimately, whether we are completely handing the wheel over to the digital AI chaperone or simply using it to help our human navigators chart a safer course, the landscape of commercial risk has permanently changed. Thank you for joining us on the debate.